Something just changed in XRP that matters more than it looks. Major U.S. banks are disclosing XRP ETF exposure. At the same time, Ripple is pointing towards a much larger stablecoin opportunity, corporate treasury. In the next few minutes, we'll connect those filings to Ripple's treasury infrastructure, 13,000 connected banks, and the shift from cross-border payments towards 24/7 corporate liquidity. The headline numbers are easy to dismiss. Wells Fargo disclosed roughly 9.18 million in Bitwise XRP ETF exposure. Bank of America disclosed more than 13,000 shares in a volatility shares XRP ETF. For banks measured in trillions of dollars, those positions are small. But the dollar amount may not be the most important signal, ladies and gentlemen. The more important question is how XRP-related exposure is entering the institutional financial system and why these disclosures are appearing alongside Ripple's expansion into corporate treasury and stablecoin infrastructure, ladies and gentlemen. Because Ripple's strategy may be broader than simply moving money across borders. Its treasury infrastructure connects corporate cash management with banking data, payments, FX, and digital assets. And if stablecoins become part of the treasury workflow, the opportunity isn't limited to international transfers. It potentially reaches the money corporations manage every single day. That's where the XRP story starts to look very different. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. And thank you always to everyone who likes and shares each of our videos. These two things really do help out our channel very much. Here's the statement that changes the frames, ladies and gentlemen. Ripple's senior vice president responsible for stablecoins, Jack McDonald, discussed the opportunity around stablecoins and corporate treasury. The key idea was that the major opportunity extends beyond simply using stablecoins for cross-border transactions. It involves corporate treasury operations. Now stop there, because this changes the question. Instead of asking how many international payments can XRP facilitate, you start asking how much money does the global corporate sector manage every single day. That's a completely different story and market, ladies and gentlemen. A corporate treasurer isn't necessarily thinking about cryptocurrency. They're thinking about liquidity. They're thinking about cash management. They're thinking about settlement. They're thinking about working capital. They're thinking about foreign exchange. They're thinking about payments. They're thinking about where money sits overnight. And they're thinking about how quickly they can move that money when the business needs it. This is so important because a digital asset infrastructure capable of operating continuously could potentially address some of those problems. But here's where it gets interesting and spicy. See, the biggest transformation may not be replacing one international payment rail at once. It may be changing the definition of when money is available. Imagine a corporation receives a large payment late Friday afternoon. The company doesn't stop operating because it's Friday. Employees are still working. Suppliers still need to be paid. Invoices still need to be settled. Liquidity still matters. But traditional financial infrastructure has historically operated around banking schedules, settlement windows, and jurisdictional constraints. Now imagine a treasury system where a compliant digital dollar can move simultaneously and continuously. Saturday, money can move. Sunday, money can move. A holiday, money can move. That doesn't automatically mean every company will adopt stablecoins now. But it explains why institutional interest in tokenized money is growing. The potential benefit isn't simply speed. It's capital efficiency. And that distinction is critical. There is a useful historical parallel here, ladies and gentlemen. In the second half of the 20th century, financial institutions increasingly moved away from physical and paper-based payment processes towards electronic systems. The transformation wasn't simply about making a check faster. It changed how banks thought about information, settlement, and liquidity. Electronic systems eventually became the infrastructure beneath modern finance. The lesson isn't that stablecoins are guaranteed to replace traditional banking. The lesson is that financial infrastructure can change dramatically while the underlying function remains the same. Money still needs to move. Businesses still need liquidity. Banks still need settlement. The infrastructure simply evolves. And that brings us back to XRP. Because if digital assets become embedded inside treasury systems, the important question isn't whether a corporation calls itself a crypto company. Most won't. The question is whether digital assets become invisible, infrastructure. This is where Ripple's treasury strategy becomes particularly interesting. Ripple Treasury, formerly associated with G Treasury, is designed around institutional treasury management. The platform connects corporate treasury operations with banking and financial infrastructure. You have to realize that more than 13,000 banks and approximately 1,200 corporate CFOs and treasury professionals are already in the mix with this. See, those numbers matter because this isn't a consumer crypto wallet narrative. We're talking about enterprise treasury, ladies and gentlemen, the people responsible for managing corporate liquidity. And the platform's Clear Connect gateway provides connectivity around bank balances and transportation and transaction reporting. Among the institutions associated with the infrastructure are major banks, including Wells Fargo, Bank of America, Goldman Sachs, and JP Morgan. Now, let's be precise. A banking integration does not mean that a bank has adopted XRP as its primary settlement asset. No, that's an important distinction. Infrastructure connectivity is not the same thing as XRP utilization, but it does create something extremely valuable, distribution. And in financial technology, distribution can be more important than the technology itself. Now, this is what most people miss. Think about what Ripple would be building if this treasury strategy succeeds. It won't necessarily be selling XRP to corporations one by one. No, it would be putting digital asset capabilities inside the systems corporations already use. That's a completely different go-to market strategy. The CFO doesn't necessarily need to wake up and say, I want to buy cryptocurrency. Instead, the Treasury Department could eventually see digital assets alongside traditional cash positions. The technology becomes part of the workflow. That's the same way many people use payment infrastructure today without thinking about the underlying networks moving their money. This is potentially the most important part of the entire thesis. The winning financial technology may be the technology users barely notice. Now let's bring in the recent institutional disclosures, the Wells Fargo disclosure, ladies and gentlemen. Wells Fargo reported exposure to a Bitwise XRP ETF. The reported position was approximately 9.18 million. Wells Fargo is enormous. Its balance sheet is measured in the trillions. So yes, let's address the obvious objection. $9 million isn't transformational for a bank that size. That's absolutely true. But the more interesting question isn't how much money did Wells Fargo allocate? The more interesting question is, what does the filing tell us about institutional permission? A regulated financial institution reporting an ETF position is different from an anonymous investor buying XRP. No. The institution has governance structures, risk controls, compliance procedures, investment committees, reporting obligations, and regulatory oversight. So an initial position could be interpreted as a signal of institutional accessibility, not proof of mass adoption, not proof that Wells Fargo is preparing to use XRP across its entire business, but evidence that XRP-linked investment products can exist inside the institutional framework. That's the distinction. Then there is Bank of America, ladies and gentlemen. Their 13F shows more than 13,000 shares of a volatility shares XRP ETF. Again, the position is relatively small compared with Bank of America's enormous balance sheet. And that's exactly why we shouldn't exaggerate the dollar amount. The signal is not necessarily the size. The signal is participation. Two major U.S. financial institutions, separate filings, XRP-related investment exposure, and institutions that already have relationships with Ripple-related financial infrastructure. Could that represent coordinated strategy? It's possible. Could it simply represent portfolio exposure to newly available regulated products? Also possible. We don't know from the filings alone. And that's why we need to separate evidence from interpretation. This is one of the most important principles when analyzing XRP. Short-term noise, long-term structure. The market can obsess over 9 million position, but institutional infrastructure develops over years. A bank doesn't rebuild its treasury architecture because XRP's price moved 5%. It does because the financial system is changing. And this is where the stablecoin conversation becomes much bigger than XRP itself. Stablecoins are effectively programmable representations of money. They can potentially operate continuously. They can interact with software. They can settle transactions automatically. And they can potentially connect traditional financial assets with blockchain infrastructure. That makes corporate treasury a neutral battleground. Think about the railroad. The railroad wasn't valuable because people loved locomotives. It was valuable because it changed the economics of moving goods. Distance became cheaper. Markets expanded. Businesses reorganized around transportation infrastructure. Digital financial networks could create a similar effect. The question isn't whether corporations become crypto companies. No. The question is whether better financial infrastructure changes the economics of managing capital. That's the analogy. Railroads change the movement of physical goods. Digital settlement networks could change the movement of financial value. Different technology, same structural principle. Now let's zoom out again. The United States has 8 banks classified as globally systematically important banks, commonly referred to as G-SIBs. They include JP Morgan Chase, Bank of America, Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, BNY Mellon, and State Street. These aren't ordinary financial institutions. They sit at the center of global capital markets, ladies and gentlemen. And Ripple is rumored to have relationships, partnerships, or infrastructure touch points across this group. But again, we don't need to distinguish categories, ladies and gentlemen. A partnership isn't necessarily XRP adoption. A treasury integration isn't necessarily XRP adoption. An ETF position isn't necessarily direct XRP usage. And a stablecoin partnership isn't necessarily an endorsement of XRP. Those distinctions actually make the analysis stronger because we're not pretending every relationship means the same thing. What matters is the convergence, banking infrastructure, treasury management, stablecoins, tokenized assets, regulated XRP investment products. These are increasingly occupying the same institutional conversation, ladies and gentlemen. And this doesn't stop in the United States. Ladies and gentlemen, when you look at what Ripple is doing with HSBC, BNP Paribas, Deutsche Bank, MUFG, and SBI Financial Group, this all rumored to have relationships and partnerships involving Ripple. That's massive. You have to really take a step back and actually physically understand how massive those players are in the global financial system. And it matters because the global banking system is interconnected and those players span the globe. Corporate treasury isn't contained within one country. A multinational corporation might have dollars in New York, euros in Frankfurt, yen in Tokyo, sterling in London, and subsidiaries operating in dozens of other jurisdictions. That creates a giant liquidity management problem. The larger the corporation, the more fragmented its financial operations can become. So the potential opportunity for digital treasury infrastructure scales with complexity. Here's another real historical development that helps explain this. After World War II, the global financial system evolved around an enormous offshore dollar market known as the euro-dollar system. Dollars could effectively circulate outside the United States through international bank networks. This simply wasn't a story about a new currency. It was a story about financial institutions finding more efficient ways to manage dollar liquidity across borders. The important lesson is that the location and infrastructure of money can evolve when the underlying unit of the account remains familiar. Today, the dollar remains dominant, but the infrastructure underneath the dollar is changing, and stablecoins could become one layer of that evolution, ladies and gentlemen. I want you to imagine a large multinational corporation. It doesn't necessarily want XRP. It doesn't necessarily want Bitcoin. It may not care about crypto at all. What it wants is faster settlement, better liquidity visibility, lower friction, automated reconciliation, 24/7 availability, efficient foreign exchange, and the ability to move capital between entities when needed. If blockchain infrastructure can provide those benefits while remaining compliant and integrated into existing treasury software, the corporation doesn't need to become a crypto believer. It simply needs the economy and economics to make sense. It has to make sense, ladies and gentlemen. That's the difference between speculation and infrastructure adoption. Here's the second analogy I want to discuss. The internet didn't become economically transformative because every dollar wanted to become a telecommunications company. No. It became transformative because the network disappeared into everyday business. Email, cloud software, online payments, supply chains, customer service, commerce. The infrastructure became invisible. Corporate blockchain adoption could follow a similar path. The future isn't necessarily every CFO talking about XRP at the boardroom table. The future could be a treasury system quietly using tokenized dollars and digital settlement infrastructure in the background. If that happens, the user experience becomes really boring. And ironically, boring infrastructure can be extremely powerful. So where does XRP, the anointed one, fit into all of this, ladies and gentlemen? Potentially as one component of a broader digital liquidity architecture. XRP and RLUSD are not identical. RLUSD is designed as a dollar-denominated stablecoin. XRP is a separate digital asset. Their functions can therefore be complementary rather than interchangeable. A stablecoin can represent dollar value. XRP can potentially provide liquidity or bridge functionality. The important point is that Ripple doesn't necessarily need every corporate treasury transaction to be an XRP transaction for XRP to matter. No. If XRP becomes one of the liquidity assets connecting a larger digital financial ecosystem, its role could theoretically expand alongside the network. But that remains a thesis. It is not a guaranteed adoption, ladies and gentlemen. And this brings us to the regulation, because institutions don't operate like retail traders. They need legal clarity. They need custody frameworks. They need accounting treatment. They need risk rules. They need compliance. They need to know what they're allowed to do. That is why legislation such as the proposed Clarity Act matters so much to this broader institutional story, ladies and gentlemen. Regulatory clarity could potentially make it easier for financial institutions to determine how digital assets can be held, offered, custodied, and integrated. But we should be very careful here, ladies and gentlemen. Regulatory legislation can change. Bills can be amended. Rules can differ across jurisdictions. And no legislation guarantees XRP adoption. It doesn't. The correct way to frame this is this. Regulatory clarity could reduce friction for institutional participation. That's the potential scale, leverage, and lever, ladies and gentlemen. I want to talk about price for a system. See, this is where investors often make a mistake. They look at the institutional filing and immediately ask, how much will XRP go up? That's not necessarily the most useful question. A better question is, what infrastructure is being built? Because markets can move in the opposite direction of fundamentals for long periods of time. Prices reacting, systems evolving. Those are two different clocks. The price can be volatile, the infrastructure can continue expanding, or the infrastructure can stall while the price rises. Both things are possible. That's why the institutional story needs to be evaluated separately from short-term price speculation. So what would actually adoption look like, ladies and gentlemen? What would convince me that this thesis is becoming more than a narrative? Look for measurable evidence. More banks integrating digital asset capabilities in treasury systems. More corporations are using stablecoins for actual operational payments. Higher stablecoin transaction volumes tied to commercial activity. Greater institutional custody infrastructure. Clearer regulatory frameworks. More tokenized financial assets. And most importantly, evidence that XRP is being used, not merely held in an ETF. That's the difference between exposure and utility. ETF ownership tells us an institution can gain exposure. Actual settlement tells us the asset's being used. Those are very different signals. So let's put the entire story together, ladies and gentlemen, the three-layer thesis. Layer one, XRP and regulated investment products. Major institutions are gaining exposure through ETFs and other regulated structures. Layer two, Ripple's infrastructure, institution. Treasury management and banking connectivity potentially gives Ripple distribution to existing financial workflows. Layer three, corporate stablecoin treasury. This may be the largest conceptual opportunity because it addresses the management of capital itself, not simply international transfers. And these layers can reinforce one another. More regulatory clarity can support institutional products. More institutional products can increase familiarity. More treasury infrastructure can create distribution. More stablecoin adoption can increase demand for digital settlement infrastructure. But none of these guarantees XRP adoption. That's the key caveat. The thesis is about convergence, ladies and gentlemen. The biggest thing, in my opinion, that people may be missing, and this is a central idea. Maybe XRP was never just a story about sending money from one country to another. Maybe the larger opportunity is the digitization of financial liquidity itself. Because once programmable money arrives and is available and integrated into corporate treasury systems, the addressable market changes. Write that down. It's so massive. It's so huge. You aren't just talking about remittances. You're talking about corporate cash, supplier payments, intercompany settlements, foreign exchange, working capital, liquidity management, tokenized securities, and eventually potentially automated financial operations. That's a much bigger story, ladies and gentlemen. See, the cross-border narrative may have been the easiest story to understand. Corporate treasury may be the hardest story to see, but potentially it is the more consequential one. So remember the three things, ladies and gentlemen. First, Wells Fargo and Bank of America have disclosed XRP ETF exposure. The amounts are small relative to their balance sheets, but the disclosures demonstrate institutional access to regulated XRP investment products. Second, Ripple's treasury and banking infrastructure connects into a large network of financial institutions and corporate treasury operations. That doesn't automatically equal XRP adoption, but it creates an institutional distribution channel. And third, the stablecoin opportunity may be much bigger than cross-border payments. corporate treasury could become one of the central battlegrounds for digital dollars and blockchain-based settlement. If that happens, the biggest transformation may not be visible on a crypto exchange. It could happen inside the Treasury Department of a multinational corporation. And that's the part of this story I think the market needs to watch. Short-term noise, long-term structure. Pay attention to what's quiet, ladies and gentlemen. The price will move. The headlines will change. The narratives will rotate. But if banks, corporations, regulators, and financial infrastructure providers continue moving towards tokenized money and 24/7 settlement, the financial system itself may be undergoing a much larger transformation. And XRP's role in that transformation is going to depend on one thing above all else: actual utility, not hype, ladies and gentlemen, not headlines, not ETF speculation, actual utility. So keep watching the infrastructure, because sometimes the biggest financial revolutions don't begin with a massive transaction. They begin with a small checkbox being approved inside of a bank. If you've enjoyed this analysis, hit the like button, subscribe to the channel, and share this video with someone who still thinks XRP's story is only about cross-border payments, because the story may be getting much bigger. I'll see you in the next one, ladies and gentlemen. I hope everyone's having a blessed afternoon. I want to welcome all the new members of our Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Let me tell you something right now. The market right now is sitting at a very important levels, okay? I don't think enough people are paying attention. I don't. And I've been having phone calls all day nonstop from last night. I haven't gone to bed yet, because we're at these points that people aren't paying attention to, and then they search for narratives, and stuff people end up getting cut up like sushi. As always, ladies and gentlemen, one solid tip from the pits will pay for your entire year subscription. Come and join over 670 active traders investors inside the Crypto Public Desk Monthly who are learning to take advantage of the deeper macro research and to position before the moves happen. We do it all there, ladies and gentlemen. I want to point out something right now. See, underneath all the headlines, underneath all the noise we're seeing, major markets are testing critical support and resistance zones at the most, as far as we're concerned, almost at the exact same time. The convergence is nuts. And when you start putting all of these pieces together, you get a very interesting picture. I want to start with the U.S. 10-year Treasury. The 10-year recently broke above the upper boundary of a multi-month consolidation range. It's huge. That sounds bullish for yields. But then it ran into resistance around 4.74%, okay? And now it's pulled back. Here's the level I'm watching, 4.54 to 4.51. That's the 50-day moving average, ladies and gentlemen. Write that down. This is not financial advice, just my own opinion. And according to technical setups that we're following, that level holds. We could see yields turn higher again, potentially challenging 4.80, which was the 2025 high. Massive. But if 4.54% to 4.51 breaks, that's when things get much more interesting, because then you're talking about the possibility of a much deeper decline in yields. And that matters, ladies and gentlemen, because treasury yields don't exist in a vacuum. They feed directly into financial conditions, the dollar, equities, borrowing, costs, everything. We go over this all the time. The AI war is being financed by certain things. You've got to pay attention to this. Now, if we take a look at Germany, this is very important. The 10-year bond is sitting around 3.2%. It tried to break higher through May, and it failed. But here's the important part, because most people don't even care about the German bond. There aren't clear signs yet of a major pullback. The 50-day moving average is sitting around 3.04%. So again, we're watching a very simple technical battle. Hold support, the uptrend continues. Break above 3.20. You could be looking at another leg higher, ladies and gentlemen. And then we get the currencies. See, this is what we're paying attention to, and I spend all day on the phone talking to. It's a financial battle all day with similar financial instruments in the same category. The currencies are so important here right now. The Euro USD has already broken out of a small base and pushed higher, but now it's approaching the 200-day moving average around 1.1610 to 1.1625. That's a big level, ladies and gentlemen. If the Euro can't break through it, the broader downward move could come back into play. But if it does break, then you're talking about a potential change in momentum. Sterling is telling a similar story. 1.3270 is the number to watch. That level holds. There's room for a rebound towards the May high around 1.3660. But lose 1.3270 and the risk of a deeper decline increases. Then you got my all-time favorite, the dollar yen, baby. The dollar yen. This one's really interesting. The dollar yen pair fell sharply after running into resistance around 164. It came all the way back towards 155, and 155 now is acting as an important support level. If 155 breaks, that's where the recent, in my opinion, downtrend could become much more extended. Think about what that could mean for the global markets. We talk about this all the time. Because the yen isn't just another currency. It's tied into global liquidity and carry trades and risk appetites, ladies and gentlemen. So when the dollar yen starts making a major move, you pay attention or you get caught up like sushi. And then there's the Chinese yuan. The yuan has been struggling to regain its 50-day moving average, and it's now broken below the June low. That's a very important technical development. If it can reclaim 6.78, the decline could continue towards 6.72 and potentially even through the 2023. Around 6.69. That's wild. Again, this is where the macro picture gets interesting, ladies and gentlemen, because we're watching dollar weakness develop into multiple currencies at the same time, not just one. And when you tie that into the commodities that we're watching, this is where things get so interesting. Gold has staged a strong rebound. It formed a low around 39.40 in June, built a base, broke through a descending triangle and trend line, and pushed higher. And now the 200-day moving average around 4,490 is coming into view. The 50-day moving average around 4,150 is the important support level. So if gold can stay above that level, we're potentially looking at 4,490 and then 4,600 to 4,630. That's not a small move. And then there's oil, ladies and gentlemen. Brent crude has been consolidating between roughly 78 and 86.80. And there's the thing. Here it is. It's sitting around both its 50-day and 200-day moving averages. The market can't seem to decide which direction it wants to go. That's compression. And when you get compression like this, everything eventually goes haywire and something gives out. Break below 86.80, look out. You could get a directional move higher. Break below 78, look out. You could get another leg lower. And that is the biggest story, ladies and gentlemen. But when I look at all of these things across the board, I see Treasury yields sitting at a critical support zone. The euro is approaching its 200-day moving average. Sterling's at a key level at 1.320. The yen's testing 155. The yuan is breaking down. Gold is pushing towards 200-day moving average. And oil's trapped between two major boundaries. This is not a market where you just sit back and ignore the technicals, ladies and gentlemen. They are decision points. And when enough major markets reach decision points at the same time, volatility can show up very quickly, ladies and gentlemen. So do not get distracted by the day-to-day noise and the crying of candles. Don't do that. You watch the levels because the levels are telling us where the next market major directional move could begin. And that's the biggest mistake you can make right now, assuming you already know which direction it's going. You don't. The market hasn't confirmed it yet. It's building the pressure. And eventually, one of these levels is going to break. I rattle these things off, and this is a longer rant. And if you want to see how we position for all of these plays and moves, join the Crypto Public Desk Monthly, ladies and gentlemen. One tip pays for everything. It's one thing to hear me talk about it. It's another thing to understand and catch the move. Well, what should we do? Look at something right now. The front end of the U.S. rates curve still is pricing a 1 in 3 chance of a September rate hike, and has a hike fully priced for December, despite yesterday's dull as ditch water CPI report. And we go to jobless claims and PPI that we had today. Then we have retail sales tomorrow. I can't help think that the growth side of the Fed's mandate matters as much as the inflation side. Currently, a softest retail sales report of this kind, the Fed, it's the K-shaped economy narrative prompting economists to write about, ladies and gentlemen. How the average non-gazillionaire U.S. consumer isn't feeling particularly rich at the same time or at the same moment could further reduce expectations of Fed tightening. That would help. It wouldn't, as far as we're concerned. People said it would help. I don't think it will, because my forecast of a stronger dollar in H2, but in the short run, it probably wouldn't. Okay. It's not going to move the FX market much at all. Judging by the current lack of activity, which we just went over this, nothing's really moving. So most of the questions that I've been getting all day are still about the yen and debt sustainability. There's concerns continue to counterbalance talks of faster policy tightening, and as a result, narrowing rate yield differentials aren't really helping the yen. The possibility of another round of U.S.-Japanese intervention, which we believe is coming, has clearly showed the place of the dollar-yen rebound. But if the fiscal policy isn't tightened, oil prices don't fall sharply around, and the JB doesn't magically flatten here. The curve will not flatten here. Again, the JGB curve doesn't magically flatten here. from another test of policymakers' willingness to intervene and defend the yen seems inevitable. We are waiting for the BOJ. We gave you the levels, 106. We're waiting for that BOJ baby to come in, and with the U.S. backstopping them as well. You want to take advantage and be positioned before this happens and see how we're going to take advantage? Come and join the Crypto Public Desk Monthly, ladies and gentlemen. Join over 670 active traders. Understand this. Upward revision to Japanese growth forecast will probably be a bigger support for the yen later this year. But we have to get out of the current U.S.-Iranian impasse first. And as the rest of it, if you look at what the Norse Bank, they were hawkish coming out of Norway, enough that they raised the mites. Prices, a 60% chance of a hike in September. See, I pay attention to this. Most people don't. That's why a lot of people get cut up like sushi. So if you look at the NOK, it's still this year's top G10 currency, and for good measure. The top G10 currency of last month, too. Ladies and gentlemen, you got to understand this. This is a whole world going around. So when you look at XRP's prices, and if you hear it right here, I salute you. If you look at XRP's price and you look at the rest of the world, there's no liquidity playing right now. You got the ceasefire or whatever they call it, that passed. That deadline came and passed. And you got to understand something right now. All of these things are wasting your thought process because most investors waste time consuming information. They're not analyzing information, and you're not preparing for what's coming. We're in a fluid state right now. The convergence of all the levels I went over, the narratives I have gone over, the issues. Remember the things that we're watching right now. Somalis, pirates have been equipped by the Houthis with weapons. It is a tinderbox, ladies and gentlemen. A lot of people are going to get cut up like sushi here right now and carried out in body bags trading. Why they're not going to be ready? What to be ready for is the BOJ intervention. It's going to happen. And when it does, we're going to take advantage of it. Liquidity will come in. See, print it to win, it's begun already, ladies and gentlemen. When you look at the cryptocurrency prices, if there's no liquidity, they're not going anywhere. They're not. No news headline will, they're not. I was telling a massive family office I've worked forever. They actually was one of our first investors in our first concessions that we built. I compared to what's happening right now in the cryptocurrency market and blockchain like mining. We're breaking ground. We're following all of our geological surveys to target what we're going to recover and why. It's so boring in the beginning. You don't know. It's not glamorous. It's real, real boring. But the world needs the metal. The world needs the end commodity. The world needs XRP, ladies and gentlemen. It needs ICP. It needs HBAR. It's changing here right now. And you have to ask yourself this, right? If it's so bad and it's useless or garbage, why are banks disclosing that they have it? Even older banks, even older bank in Canada disclose they have it. Because it works. It works. XRP works. Anyone on our side of the tranche in the Mariana Trenches knows it works. I've been telling everyone here on these videos, we use it for complex hedging on our desks all over the world. So get this Gucci conviction. Get this Gucci clarity. We're walking up this frosty mountain, drinking our frosty beverage. Do not lose hope. Understand the world is changing. We are on our XRP concession mining and recovering, and understand that the world needs this and it's going to change. It's just not going to happen in anyone's time frame. It happens when it's ready. None of this is financial advice, ladies and gentlemen. My own opinion. This video is for educational entertainment purposes only. Always consult your licensed financial advisor before making any investment decisions. Never invest a single dollar from watching a YouTube video. Don't ever do that. These are my own opinions, and anyone that retains myself or organization in any capacity. You know, we had a phenomenal Zoom call yesterday. It was amazing. I love getting to know everybody, talk about things. It's amazing, and it's wild when you hear at least how we look at this and how we apply what's happening. Having different perspectives at the same XRP lunch table is very, very important. That's why we're all in the XRP army. Some people see this perspective. Some people see that perspective. I see this perspective. And we all put it together. And it works for us. But ask yourself, why would you throw the towel in now? Why would you do that? You don't do that now. You don't do that now. Unless you want to. You're seeing the human psychology of trading and investing right here, right now. The emotions part of it. No matter how many places you may read the cycles of everything, until you experience it, it's like telling someone, don't touch the stove, it's hot. You'll burn your hands. Sometimes you got to burn your hand to see what happens. I love you all, ladies and gentlemen. I'm going to see you on the front lines. Don't FOMO this. Don't overthink this, ladies and gentlemen. Rewind and write down the key levels of things I just said, because if you take in the levels, and most of the time I'm talking about the headlines, it tells you a lot. I love you all, ladies and gentlemen. I'll see you on the front lines.